Hey, I'm Anton. I'm a certified financial planner here in Tasmania, Australia, and this is financial planning for business owners. The issue I wanted to talk about today is whether you're getting the most out of your family trust. Are you maximizing the benefits of using your family trust as a business owner? Um, Most of the time, when we set up new business structures, or maybe we're restructuring, we will include a family trust somewhere in the business structure. Either maybe the business owner will run their business through the family trust, or maybe it's a shareholder or a unit holder. Um, but it's very common when I start working with new clients and that already have family trusts in their business structure somewhere, that they're not really maximizing the benefit of having a family trust. A recent example is a lady business owner I started working with just in the last month, and she's owns shares in a really good business. So she only owns half the business, but owns shares in a really good business, gets really good dividends every year. But by better planning her distributions, she's going to save about $45,000 in tax this financial year, and it's also going to better set her up for creating wealth, investing for the future. So, and really, the issue of the family trust I find is that a lot of the time when new business is set up, and the family trust is recommended somewhere, it's a little bit of a complicated thing, and it's not often really well understood what the potential benefit of the family trust is. And if there's not a bit of thinking and planning that goes into it from year to year, then a lot of the benefits often is lost. So what should you do? Like that's the main question. The main thing is really on a yearly basis, you should do tax planning for your family trust. Ideally do this with your accountant and your financial advisor. It's good if they're working together to get the best benefit for you out of your family trust. The main thing to think about with family trust and maximizing the benefit is that you have to think and plan who the beneficiaries of the trust are and who you're going to actually distribute profits to. Remember that the main reason why we recommend a family trust is that from year to year, whatever income or capital gains the trust make, you can then decide who you should distribute to. So what should you be thinking about? So the first thing is thinking about yourself as a beneficiary. It's very often that you won't distribute any income to yourself. So like in this example, in the last month, this lady, quite a bit of the trust income was being distributed to her personally, but she was paying tax at the top marginal tax rate on that income, so 47%, and there's no reason for that. The next thing you want to then consider is if you have a spouse, whether you can and whether you should distribute income to your spouse. Often we would recommend that if your spouse is on a lower tax bracket, spouse or partner is on a lower tax bracket than yourself. So obviously that's the kind of the starting point, splitting income between yourself and your spouse. The next very common strategy that we recommend, obviously all this needs to fit in with the trust deed and with other tax rules, but you should seriously consider whether you should distribute to a company. So often, and a beneficiary company, often these are called bucket companies. I don't really like that term very much. I prefer to call them private investment companies or just your private company. But that's one area where you really should consider. That's only really, in my opinion, recommended when we're actually going to use this company to hold long-term investments for the future, actually using this company to invest, either for an investment purpose or a business purpose. But usually the benefit of distributing to an investment company or a bucket company, if you want to call it that, is the company will receive the distributions from the family trust and pay tax at the company tax rate. Typically, it's the 30% rate, not the 25% rate for small business companies. And then The main thing is that the company actually needs to receive that money. You can't go and spend it, so that the money needs to go to a bank account for the company and use it to invest in the company. The next beneficiaries, maybe this comes before a company, that you should consider are children, and this often I see is missed. Now, when children are under 18, or they're classified as minors, then they only get a tiny little bit of distributions, and sometimes we don't even do that, so usually $416 a year. But when your children become adult children, turn 18, well, I think there's a rule that, if they're a bit younger but they're working full time for a big part of the financial year, they can also get distributions. So if your children are 18 and you're actually supporting them, then it's really worth considering distributing to children over 18. Now, there are some rules around that which you need to check with your tax advisors, so you can't just distribute to them up to the top marginal rates and those kind of things. There's some careful planning that needs to go into that. And then the last area of beneficiaries, and I also see this quite often that's missed, is that a lot of people don't realize that they can distribute to charitable, if their trustee allows, can distribute to charitable organizations like their church or their religious organization, maybe educational institutions they support, charities that you can't claim tax deductions for but still fits within the deed. And so that's a really important area to consider as well. So long story short, do planning for your trust every financial year, and carefully consider from year to year who you should distribute the trust income to. That's to minimize the tax, but it also should fit in with your overall financial plan, business plan, and fit in within the tax rules, of course. And then just another point where trusts don't get used properly, I see this fairly frequently as well, where somebody already have a family trust and they're buying new assets, maybe they're buying a new property or shares, whether it's private investment assets or maybe investing in new businesses, and then they don't use the trust to purchase those assets. I'm not saying that the trust should always be used to purchase those assets, but it should at least be thought about. So to recap, plan, think carefully about your beneficiaries from year to year, review that as your circumstances change, and think about new assets for your trust. Hope it helps, and talk soon.